You are watching BNN Bloomberg. I'm Amber Kanwar. Here's what we've got coming up on the show. With the markets near all-time highs in the U.S. and pretty close on the TSX as well, are cracks forming under the surface with respect to concentration, with respect to regional banks? We'll put that to James Callahan, find out how he's positioned. Certainly no cracks in AI when you look at the rally that we have seen in the sector. We're going to take a peek at the private equity side of things, the venture capital landscape for AI. Jordan Jacobs, the co-founder of Radical Ventures, will be joining us in just a couple minutes' time. At 11:40, hot picks in the retail sector. We saw a lot of high-profile wins last week. We'll get best ideas from Adrian Yee joining us from Barclays. But first, let's get straight to our top interview. Sun Life Financial stock's up about 3% in the past week after posting quarterly results. Underlying earnings grew more than expected, but losses in commercial real estate widened more than expected. To discuss this, we're joined now by Kevin Strain, the president and CEO of Sun Life. Kevin, thank you so much for joining us, as always. We kind of highlighted the difference between underlying earnings and then reported earnings. And the gap, as we mentioned, is because of that real estate exposure and the struggles that you've seen there. Help us understand what's going on with that part of the portfolio.
Well, first, Amber, how are you today? It's nice to talk to you again. And as you said, our stock had a nice run up last week with our earnings. On the global real estate, we're a long-term investor, and we've had strong returns out of real estate over the long term. In fact, real estate continues over the past 10 years to outperform our expected return from real estate. You have seen a slowing, was in retail, and retail is starting to come back a little bit, but certainly in the office space coming out of COVID. And what you saw was a bit of that weakness in the quarter. We've been preparing for that. We had been dialing down on office even prior to COVID. But it's we still have an investment inside of real estate, and you did see the impacts of that as appraisals started to come through and coming out of COVID.
And I should emphasize that these are kind of mark-to-market losses, right, versus realized losses. You haven't actually taken those losses because you haven't sold those in the portfolio. How are you thinking about that? Are you looking to sell, or do you see reasons to hold and realize sort of long-term value in the real estate market?
Well, if we're an insurer, so we have long-term liabilities, and so real estate is a good asset class to back our liabilities. And like I was saying earlier, we are seeing the long-term investment returns being very strong here. So we're not looking to divest in general out of real estate, although of course we look at different properties and we're always changing the mix of our real estate portfolio. But longer term, we see this as a good investment class. We do see that probably this year will continue to be a bit of a headwind, particularly in the office space. But eventually, that's going to right itself, and this class will become one that grows over time. We think that people are coming back to the office, and you can see that. I'm in downtown Toronto today, and it's even busier on a Monday. So that sort of piece. I don't think people are going back to work full-time anytime soon either, but you are seeing more and more flow back into the office space.
Could that headwind that you mentioned that might persist this year get a little better if and when interest rate cuts start to be delivered?
Yeah, interest rates are obviously going to help as well. So, and we're looking at interest rates and expecting that maybe not as much cut as others expect, but probably into the mid-year sort of time frame, the interest rates starting to come down a little bit, which will be good for the economy, and I think good for real estate investors and good for retail real estate in particular. Now, we don't own retail real estate, but we do have some multi-res, and I think for homeowners, that decline in interest rates will be particularly a good signal.
These issues in real estate and commercial real estate, they've certainly shown up on the shores of regional banks at the same time that we're getting all-time highs or close to all-time highs in the market. How do you reconcile those two things? Is that anxiety and the pain and stress in commercial real estate a canary in the coal mine, or do you view it as contained within the context of the market surging?
Well, they're very different things. Of course, the markets are surging off of the Magnificent Seven. So you've seen a big drive in the markets from the Magnificent Seven. The markets are pricing in some substantial interest rate decreases during the year, and we see that as being a little bit probably stronger priced in than we expect to actually happen, but who knows? Interest rates are really hard to predict. But I think they're two very different things. I think what you're really seeing, there's parts of real estate, industrial, cold storage, infrastructure, which I sort of consider as part of real estate, that are actually doing very well. It's mostly been the retail space, which is starting to come back, and office. And as I said earlier, the office space is quite disconnected in terms of valuation because it's driven by the work from home and COVID and those types of things versus what you're seeing in the broader markets, which is more driven by the Magnificent Seven. So I think they're very different things that you're seeing happening and that you're experiencing.
I want to talk about the market environment right now in the context of your business. It affects various lines, as we know, but MFS, the asset manager, is still experiencing outflows. How can we have kind of the market so robust and still experiencing outflows there?
So, it's there's a combination of things that are happening. There's still close to $6 trillion of cash on the sidelines. And as you start to see that cash come into the markets, we think that will have an impact. A lot of the market surge is in the Magnificent Seven, which I mentioned earlier. If you're an asset manager with a long-term view, there's limitations also on how much of the Magnificent Seven you can hold. So you start to see a difference in the returns between sort of indices and sort of that long-term fundamental holding that an MFS would do. MFS continues to outperform for the year its competitors. It became the #9 largest by AUM fund manager in the United States retail space and also global. So we think, again, that if you think long-term about asset management and MFS's role, it's really important that you look long-term from a value creation. We watch closely on performance and how they're performing for their clients. We watch closely on their culture and their investments culture. And I think they're doing a good job of keeping both of those in line. And from a return standpoint for our shareholders, you see them performing very, very strong results in terms of earnings, ROE, their return over their AUM. So overall, we think MFS is it's got an important role in this broader sort of asset management platform we have that extends from active asset management, both public and fixed income and public equities that MFS does, into that more alternative space where we were seeing positive flows.
I want to talk about the U.S. insurance business. As you know, a number of health insurers in the U.S. surprised investors with just how high medical costs and utilization of insurance has been. I know that Sun Life has big exposure on the dental side. Is the experience similar? Are people going for services a lot more as kind of the pandemic recedes into the background? How is that evolving for you in the U.S.?
So, broadly, we play in a bunch of different areas in the U.S. group benefit space, and which is increasingly becoming a health business for us. And overall, that business performed very well during the year. You saw a tremendous lift in their earnings, close to $800 million USD. And that's been driven by a bunch of factors. Their health and stop loss business, which sort of plays stop loss at the top side of the health system. We're seeing really good experience in that business. Our core group benefits business also had a very strong year. The dental business, which is a little bit more tied to Medicare and Medicaid type projects. You saw the end of the public health emergency in the United States, and certain states were moving people quite quickly off of Medicaid, and that had an impact. For us, I think you can see in our results, the dental business income was down a little. We think that's a temporary blip. We've had great sales in that business, and so you should start to see that return over the next few years back to the levels of profitability we had priced in when we bought the DentaQuest business a few years ago.
I wonder if here at home, which Canada posted strong growth for you year over year, but I wanted to get your 2 cents on a story that we were following with Manulife reversing a deal with Loblaw to exclusively fill certain prescriptions through their pharmacies. This was for specialty medicines, for chronic illnesses. This came under fire by the government. Is this something that Sun Life had ever contemplated? Is this being driven by industry dynamics? I'm just wondering, as an industry participant, do you have insight into maybe how that deal came about or why it made sense?
I can't speak for Manulife. On our side, in terms of pharmaceuticals, we offer sort of full choice to clients to use whichever pharmacy they want to go to.
You've mentioned kind of the rally in the Magnificent Seven. I'm always curious to speak with executives about how that's showing up in your everyday life. Generative AI and the game-changing nature of it. As a CEO, are you buying this technology? Are you implementing it? Can you give me some examples of how it works in your business?
Yeah, we're experimenting with generative AI right around Sun Life. So we've got experiments happening in all of our businesses. We're looking at it as being a way to create efficiencies, to create ways of moving more quickly, of creating value for our clients, and also doing things in a more efficient way. And we're doing this in I would say, an experimental way where we're test and learning, and we're driving different outcomes. We're trying it in different parts of the business. We think it will have long-term impact, but you also have to manage some of the risks that are involved in it. So it's, I think that this is going to be an important turn for business. I think it's going to help us drive lots of different ways of doing things and being more efficient. But it is one that, you want to do it carefully.
Do you see the productivity and the potential cost savings that it could present to your company? I mean, so much of being an insurer is running data, running models.
Yeah, it's going to absolutely help productivity. And how do we get more data, understand our clients better, and then use that data to help them out more?